we started previously, in the previous lecture, with presenting the variances or the variance analysis of Web Company. And of course we said that Web Company manufactures jackets and only incurs manufacturing costs, of course, in order to simplify our example. And we also assume that we do not have any raw materials inventory, we do not have beginning or ending inventory, we do not have any beginning or ending finished goods inventory, and also we do not have the beginning and ending work in process inventory. To make it just simple, in order to focus upon only one thing, which is the variances. Of course, we presented our first analysis or level 1 analysis of this Web Company, and we said in order to present our variances, we need to compare two things. We need to compare the static budget, which is a budget that is prepared before the beginning of the period. It is prepared according to the budgeted output level and according to the budgeted selling prices and costs, different costs. If it is variable, if it is fixed, we are talking about budgeted costs and selling prices. We need to compare this static budget with the actual results. Of course, the actual results is according to the actual output level and the actual selling prices and actual costs, whether it is variable or fixed. And we said if we compared the two, we are going to have something called the static budget variances, as we can see here. The difference between the static budget and the actual results are called the static budget variances. But we said that according to this analysis, according to level 1 analysis, we cannot divide, or we cannot know exactly why this static budget variance is there. We cannot pinpoint the exact cause of this variance. Why? Because we have two different variances or two different causes for this variance. Cause number 1 is because of the difference between the actual and the budgeted units that has been sold and produced, of course. Therefore, this is the cause number 1. Therefore, 93,100 unfavorable static budget variance can be related to two causes. The first, the difference between the actual and budgeted units sold, or the output level. The second difference, or the second cause of this 93,100 is because of the differences between the budgeted selling prices and budgeted costs and the actual selling prices and the actual costs. Therefore, the second cause is the difference between actual and budgeted selling prices and costs. And we said in order to analyze this variance of 93,100 unfavorable variance, which is the static budget variance, we need to prepare another budget, which we called the flexible budget. And we said from the term itself that the flexible budget is a budget. That means it will consider or build or prepare the amounts or present the amounts according to the budgeted selling prices and budgeted costs. So what is the difference between the flexible budget and the static budget? We said that the flexible budget will consider the actual output level, which is the actual number of units produced and sold, while as the static budget considered the budgeted number of units produced and sold. So this is the difference between the flexible budget and the static budget. And if, of course, we said another difference, because we need to know first of all what is the actual output level. Therefore, the flexible budget would be prepared at the end of the period, after the end or after the period has finished, while as the static budget, as we just said, would be prepared at the or before the beginning of the period. So, how we are going to prepare the flexible budget? We are going to use the $120 as the selling price. We are going to use the $60 as the direct materials cost per unit. We are going to use the $16 as the direct manufacturing labor hour cost. And we are going to use the $12 for the variable manufacturing overhead costs per unit. And we are going to use the $276,000 as fixed expenses. Who can tell me why did we choose the 276,000 fixed expenses and not the 285 that was presented in the actual income statement?
Because it does not change or affected by the number of units.
Excellent, excellent. Excellent, excellent. Therefore, according to the example, they gave us the relevant range to be from 0 to 12,000 units. Therefore, any change in the number of units sold or produced and sold would not affect our fixed expenses. Correct? This is the definition of the fixed expenses. We define fixed expenses in cost accounting 1 to be expenses that would not change in total, of course, as the volume of production changes, of course, within the relevant range. Therefore, the change between the 12,000 units and the 10,000 units is still within the relevant range. Therefore, the budgeted $276,000 as fixed expenses would be the same under the static budget and under the flexible budget. Any questions? Of course, according to these budgeted amounts, according to these budgeted selling prices and costs, we are going to build up our flexible budget, but according to 10,000 units, which is the actual output level, not the 12,000, which is the budgeted output level. Any questions? So,
why the fixed cost that differ from actual and budget?
we are going to talk about this. We have chapter number 8, all about the variances of the manufacturing overhead, whether it is variable or fixed. We are going to talk about this in details, inshallah. Now, let us break up this 93,100 unfavorable variance onto the two different causes. Why do we need to do this? Because as we said, the manager was able to come up with the 93,100 unfavorable variance, but he came up to you and said that the 93,100 unfavorable variance was not detailed enough in order to make any corrective actions, in order to take any decisions according to this number. I do not know exactly why is this 93,100 unfavorable static budget variance. Therefore, we need to know exactly what is the amount that is related to cause number 1 and what is the amount that is related to cause number 2. In order to do this, we are going to prepare a level 2 analysis. As we said earlier in the previous lecture, the variances or the variance analysis is classified from level 0 to level 3. Of course, level 0 is the least detailed. It gives us only an overview of the whole amount of variances, but as we go up with the levels, we are presenting more details within our analysis. Therefore, we said that this level, or level 1 analysis, is the analyzing or comparing, or the comparison between the static budget and the actual results. So what is the level 0?
Only giving the variance.
Excellent.
Only the variance, and it's unfavorable or favorable.
Excellent. Therefore, level 0 would only be the comparison between the 14,900 net operating profit or actual net operating profit and the 108,000, which is the static budget net operating income or net operating profit. The comparison between these two numbers only is called the level 0 analysis. Now, the level 1 analysis does not only compare these two numbers, but also give us the details on how these numbers were achieved. Therefore, the level analysis or level 1 analysis would compare the revenues, would compare the different costs in order to achieve, or in order to divide up this main, or this, let us say, this big number or this vague number of 93,100 into the different variances of costs and the selling price or revenues. This would be the level 1 analysis. Now let us consider the level 2 analysis. The level 2 analysis would divide the 93,100 onto the two different causes, cause number 1 and cause number 2. So, as we can see here, this is our level 2 analysis. We have, of course, the actual results, the same that was presented in level 1 analysis. We have the static budget, which was the same also that was presented in level 1 analysis. And now we have a new item, a new column that is called the flexible budget. So the static budget, how did we prepare the static budget? We multiplied the budgeted selling prices and costs by the budgeted output level. Correct? How did we build up or prepare our flexible budget? We multiplied the budgeted selling price and costs by the actual output level. Now, how did we prepare the actual results? We multiplied the actual selling prices and costs by the actual output level. So as we can see here, if we are going to compare the static budget and the flexible budget, the only difference between these two is not the budgeted selling prices and costs, but the difference between the two is between the budgeted output level and the actual output level. Therefore, any variances that would be achieved or any variances that would be calculated by this comparison is because of the difference between the actual and the budgeted number of units produced and sold, or the actual and budgeted output levels. Therefore, as we can see, now we could divide, or we could know exactly what is the number that is because of cause number 1. Now, let us consider the flexible budget and the actual results. If we compare the flexible budget and the actual results, as we can see here, the only difference between the two, both are according to the 10,000 units. Both are according to the actual output level. But the only difference between the two is related to the selling prices and costs. The flexible budget considers the budgeted selling prices and costs, while as the actual results consider the actual selling prices and costs. Therefore, any variances that come up from this comparison, or any variances that are calculated according to this comparison, is because only of the difference between the budgeted and actual selling prices and costs. Therefore, according to this variance, we could relate this variance, or we could know exactly what is the cause of this variance, which is cause number 2. Any questions? As we can see here, the level has increased and the amount of details also has increased. Because as we can see here, the static budget variance, now that was in level 1 analysis, was divided onto 2 different variances, which is the first called the sales volume variance and the second called the flexible budget variance. The sales volume variance is because only of the difference between the actual and the budgeted output level, while as the flexible budget variance is only because of the difference between the actual and budgeted selling prices and costs. Therefore, as we can see here, all these variances, or the sales volume variance by the amount of 64,000 unfavorable and the 29,100 unfavorable flexible budget variance, after adding these two up, would present the 93,100 unfavorable variance, which is the static budget variance. Therefore, according to our level 2 analysis, we only just divided the 93,100 unfavorable variance onto the 2 different causes that we came up with the previous lecture. Any questions?
Could we have one unfavorable and one favorable?
Of course. In calculating the static budget variance according to 2 different variances, if both are unfavorable, we add up. If one is favorable and the other is unfavorable, we deduct each from each other, or one from each other. All right? Think of it as the debit and the credit, the same manner. In the same manner, we could calculate the amount or the static budget variance, or we could calculate the total amount of 2 or more different variances. So as we can see here, the static budget and the flexible budget would have the 2,000 units, of course, unfavorable variance. Also, we would have the 240,000 by the comparing of the static budget and the flexible budget, and so on. Of course, as we can see here, this is unfavorable. Why? Because we should have 1,440,000, but according to the actual output, we only had 1,200,000. Therefore, the revenues decreased from what has been or what was expected. Therefore, it is unfavorable. While as for all the costs, as we can see, it is favorable. For all of the variable costs, it is favorable. Why? Because according to the static budget, we would have more costs than according to our actual output level. Therefore, all the direct materials, direct labor, and the variable manufacturing overhead are favorable, while as according to the fixed, as we can see here, it is 0. Always the fixed expenses variance according to the sales volume variance, according to our comparison between the static budget and the flexible budget, is always 0. Because always the fixed expenses in the static budget would equal the fixed expenses in the flexible budget, as we just explained. Any questions? Of course, from the term itself, sales volume variance, that means that these variances is only because of the difference between the sales volume. While as here, the flexible budget variance, the cause is, the reason of this variances is because we have different actual and budgeted selling prices and costs. Of course, as we can see here, the variance between the output level is always 0 in the flexible budget variance. Why? Because the flexible budget uses the actual output, while as the actual results also uses the actual output. Therefore, always we would have the 0 as the variance between the actual output level. Now, of course, as we can see here, the revenues should have been 1,200,000. While according to our actual results, it was 1,250,000. Why? Because we have a different selling price. The budgeted selling price was $120, while as the actual was $125. This variance is called the selling price variance. This variance between the revenues, or between the 1,200,000 and the 1,250,000, or the variance by the amount of 50,000, is called the selling price variance. Why? Because it is concerned only with the selling price. The change here is because of the selling price, not other than the selling price. Any questions? Now, as we can see, as we go further down, the first variable cost is the direct materials. As we can see, according to the flexible budget, we should have incurred $600,000 as direct materials costs, according to $60 as the cost per unit of direct materials. While as the actual was $621,600, according to a cost of $62.16. Therefore, as we can see here, we have a direct materials variance or direct materials flexible budget variance by the amount of $21,600. Is this variance because we had different output levels? Of course not, because these output levels are identical, as we just saw in the analysis. While as the cause of the $60, or the difference between the $60 and the 62.16 is exactly what? It is because of the different costs. Because we have here a budgeted cost per unit by the amount of $60, and here the actual cost was $62.16. This is why we have an unfavorable variance by the amount of $21,600. The same goes for the direct manufacturing labor. The direct manufacturing labor budgeted cost per unit is $16, while as the actual was $19.8. Therefore, this variance is only because of this difference. Is only because of the difference between the budgeted cost per unit and the actual cost per unit. The same goes for the variable manufacturing overhead. The budgeted is $12, while as the actual was $13.05. Of course, here we have the fixed manufacturing costs variance by the amount of 9,000 unfavorable. Why? Because according to our budget, we should have incurred only $276,000, while as the actual presented us with cost, that means we incurred actual cost by the amount of $285,000. Therefore, we have a 9,000 unfavorable variance. In this chapter, or in this section of our discussion, we are going to concentrate upon the direct materials and the direct labor. We are going to concentrate in our discussion now or in the coming lectures on the direct materials variances and the direct manufacturing labor variances. And then we are going to discuss the manufacturing overhead variances, whether they are variable or fixed. So now we presented our level 2 analysis to our manager, or to the manager that came up with the static budget variance and needed a more detailed analysis. Of course, in order to give him a more detailed analysis, we prepared the flexible budget and then compared the static budget with the flexible budget in order to get the sales volume variance, which is the variance because of the difference between the budgeted and actual output level. And we also compared or made a comparison between the flexible budget and the actual results in order to get something called the flexible budget variances, which is only because of the differences between the budgeted and actual selling prices and costs. We presented this information to the manager. Of course, now the manager needs to make decisions. He needs to understand exactly why were there these variances. Therefore, he took a look on this 21,600 unfavorable variance and took a look on the 38,000 unfavorable variance of the direct materials and the direct manufacturing labor, and said, what exactly has happened wrong here? You as a cost analyst now, you as a cost accountant, need to come up with the causes of this variance. We have direct materials. The cost of direct materials per unit was budgeted to be $60, but the actual was $62.16. The direct manufacturing labor budgeted cost per unit was $16, while as the direct manufacturing labor actual cost was $19.8. Therefore, the manager needs now to know or to understand why exactly we had these differences. Yes, we presented him with more details, but he needs also more details in order to pinpoint the exact causes of these differences. So, you as cost analysts, you as cost accountants, why do we have the 21,600 unfavorable direct material variance? What do you think is the causes of this variance? Yes, as we just said, we have a variance, unfavorable variance. That means the actual cost was greater than the budgeted cost. So you as cost accountants now, why we did have this, or what might be the reason that we have this problem or this variance?
Maybe the cost of the direct material changed and increased during this period, because we put the static budget at the beginning of the period, and the actual result appear at the end of the period, and this is a big period to make changes. And
excellent. Therefore, cause number one of this variance is because of the price. we might have different prices, or we might have a budgeted price that is different than the actual price. For instance, we budgeted the price of direct materials to be, for instance, $10. But after the beginning of the period, there was an increase or a general increase in the prices. Therefore, our prices increased by 10% of the direct materials, or by 20%, and so on. Therefore, one of the causes that might have an effect on this variance or on this difference between the budgeted and actual is the difference between the prices, between the budgeted price and the actual price. What else? Do we have another cause, or is it only this cause?
Maybe the raw material price is the same, but we forget about the shipment and it's from abroad or something.
It is also considered the price. Because in preparing our budget, we do not only consider the price or the cost of the raw materials itself, we also consider the shipment cost, we also consider the handling costs, and so on. Therefore, all is considered according to the prices. So what we might have, or what other cause that we might have? Yes? More raw materials. Exactly how?
More classification of raw materials than we expected.
That means that the quantity of the raw materials might have changed. We said that we need, for instance, 10 kilograms of this raw materials according to our budget, but according to our actual results, we used not 10 kilograms, we used 10.5 kilograms, or we used 9.5 kilograms, and so on. You all know, in order to get the cost of any object, or the cost of any, let us say, product, we need two things, correct? We need to multiply the price by the quantity used, correct? Which is the cost of any cost object. Therefore, if we are saying that the cost is different, which is exactly presented here, we are saying that the direct materials should have been costed by the amount of $60. That means that each product should have taken or incurred $60 as direct materials costs. While as the actual results show that each unit used up $62.16. Therefore, the cost here was not 60, but 62.16 or 0.16. This difference in the costs can be either because of the changes in the quantity or the changes in the price or the prices. Therefore, any direct materials variance could be divided into price variance or something we call efficiency variance, or some would call it usage variance. Therefore, the difference or the cause number one, or the cause of having a direct materials variance, which is cause number one, prices, this is called a price variance. Because according to this cause, we only have, or the difference here between the budgeted price and the actual price. While as, according to the quantity, it is called the efficiency variance, or some call it the usage variance. Which is because the difference between the budgeted quantity and the actual quantity used in our production. Therefore, as we can see here, we can say that in order to analyze the quantity, or in order to analyze this variance, or this flexible budget variance, we could say that this variance by the amount of 21,600 unfavorable variance is either because the difference between the budgeted price and the actual price of the direct materials, or because of the difference between the budgeted quantity of direct materials used and the actual quantity of direct materials used, or both. Therefore, this variance could be because of one of the causes or both of the causes. Any questions?
Maybe the raw material got stolen or ruined, or
This is considered a loss. This is considered a loss. Therefore, we might consider it as within the quantity variance. Yes, within the quantity variance. But this is considered a loss, and it should not be allocated on, or it should not be traced. It should not be traced on the production of these or these cost objects or these products, because this is considered a loss, not a cost of the production here, according to our example. All right. Any questions? Do you have any questions? Therefore, as we can see here, we can also divide the unfavorable $38,000 of direct manufacturing labor costs also to two different causes. This difference between the $16 cost per unit and the $19.8 per unit could be because of the difference in prices. But according to the direct manufacturing labor, we cannot call it a price variance. It is called a rate variance, because here we are talking about wages, we are talking about salaries. Therefore, we are talking about rates, not prices, because we do not price the human labor, we rate the human labor. Therefore, the first cause of the 38,000 unfavorable variance could be because of the difference in the rates. That means I budgeted, for instance, that the direct labor hour would cost us $10, but actually it costs us $11, for instance. Therefore, this variance is considered a rate variance, a rate direct manufacturing labor variance. As well as we could also divide, or we could also analyze the $38,000 unfavorable direct manufacturing labor variance as because of the quantity that has been used in the production process by the direct manufacturing labor, or according to the direct manufacturing labor hours. That means we could say that according to our budget, we budgeted that each unit needs, for instance, 2 hours of direct manufacturing labor, but the actual quantity that has been used was 2.5 hours or 1.5 hours. Therefore, as we can see here, the direct materials flexible budget variances and the direct manufacturing labor flexible budget variances could be analyzed onto two different causes. Cause number one, differences in the prices, or differences between the actual and budgeted prices. And cause number two, the difference between the budgeted and actual quantities. The first is called a price variance, or according to the direct manufacturing labor, it is called a rate variance, while as the second cause is called, or the second classification is called an efficiency variance or a usage variance, which is because of the quantity. So as we can see here, the flexible budget variances, which is calculated, of course, by the comparison between the flexible budget and the actual results, is concerned with the operating processes. It is concerned with our efficiency within the manufacturing process itself. While as the sales volume variance is only considered from the point of view or from the perspective of the number of units that has been budgeted and that has been actually sold. We just analyze the flexible budget variances onto price and efficiency variances, onto rate and efficiency variances. Now, what do you think is the cause of this variance, which is the sales volume variance? So, what do you think is the cause that we budgeted 12,000 units, while as the actual was 10,000 units? Demand. The demand has changed. Excellent. So, what are the causes that the demand has changed? Yes.
We lose our market share, maybe because we don't have equality. We don't satisfy our customers.
Excellent. Excellent. Therefore, the competition had lower prices than ours. Excellent. Excellent. Therefore, excellent. The quality. Therefore, the causes of this 2,000 unfavorable sales volume variance might be because of the demand was not as expected. Why? Because, for instance, the demand or the overall demand in the market was not as expected. Or the demand was not as expected for our product because the competition had lower prices. Or the demand was not as expected for our product because our quality was not as usual, for instance. It could also concerned with
adapting with change in the preference of the...
Excellent. We did not consider the changes in the tastes of the customers. Also, maybe in our preparation of the budget and the determination of the 12,000 units, we did not determine this amount by a careful analysis or by an accurate analysis. These are the reasons that we might have or that might cause this variance of 2,000 unfavorable units or the sales volume variance. Any questions? Of course, we also have another analysis for this particular section. We said that it is either because of the market share, because of the demand, or it is either because of the market size. Correct? We said that the first reason is the market size. Maybe the demand or the overall demand in the market was not as expected. Therefore, this is called the market size. And then the other three causes is because of the market share. Because we had problems either in our prices, either in our qualities, either in our specifications of the product, and so on, that decreased our market share than expected. Therefore, we also could analyze this variance or the sales volume variance onto two causes. Cause number one is because of the market share. Cause number two is because of the market size. Any questions? Therefore, by this analysis, we have finished level 2 of our variance analysis. If we need more details in order to break up the 21,600 into price and quantity, or let us say efficiency variances, and the 38,000 unfavorable direct manufacturing labor variance onto the efficiency variance and onto the rate variance, we need to perform a level 3 analysis. Therefore, what do you think a level 3 analysis according to these two items of course would be like? We said that in order to get the price variance, we need to compare the budgeted price with the actual price. Therefore, the level 3 analysis should give us the opportunity in order to compare these two. And in order to get the quantity price, in order to get the the quantity variance, or in order to get or calculate the efficiency variance, we need to compare two things. We need to compare the budgeted quantity and the actual quantity. Of course, we as accountants, we all know how to get the actual price and how to get the actual quantity. According to our recording process as accountants, we could determine what was the actual quantity and what was the actual price. But now, let us consider how we are going to determine the budgeted price and how we are going to determine, or what are the ways in order to determine the budgeted prices and the budgeted quantities. What do you think are the main sources of information that could be used in order to determine the budgeted prices and the budgeted quantities? What do you think? So what do you think? Excellent. Historical information. The fair value of the market. What do you mean by the fair value of the market? The prices of the market. Therefore, we have three different sources in order to get our information about the budgeted quantities and the budgeted prices. First of all, we could use the historical information. Of course, we have been manufacturing this product for several years. Therefore, we know what is exactly the quantity that has been used in the past, what is the price that has been used in the past. Therefore, we could use this past information in order to determine the budgeted information. We could use our experience or past experience in the manufacturing process in order to determine the budgeted quantity and the budgeted price. This is the first source of information. But as we can see here, if we use the past information, we might carry some of the inefficiencies that was within our manufacturing process in the past periods onto the future periods, which is a big problem. That means, for instance, if I'm going to use the actual quantity and the actual price that was used in previous years, we might carry some of the inefficiencies in these quantities and in these prices from the past to the future. For instance, in the past, we used, or let us say we used direct materials by the amount of 10 kilograms. This was in year 1. In year 2, we used, for instance, 9.8. In year 3, we used 9.5, and so on. Therefore, if we used our past information of course, the 10, the 9.8, and the 9.5 Some of the managers would consider taking an average. Some of the managers would consider to take only the last amount or the last period's amount of quantity. But this would be problematic if the 9.5 kilograms of raw materials used within the production had some inefficiencies in the usage process. That means we might have some parts of our manufacturing process that uses up direct materials more than it used to, or more than it should use in the manufacturing process. This would be problematic. Why? Because we are carrying this inefficiency from the past year onto the next year. That means we are saying to the employees, keep doing what you are doing. If they are performing any inefficiencies, if they are producing the products with more materials than should be used, therefore they will keep doing what they are doing. Why? Because we said that according to past year, or to the past year, or to the previous year, we use 9.5 kilograms, and this year we should use 9.5 kilograms. Therefore, if in the previous year they spilled a lot of the direct materials, they didn't use the direct materials right away, therefore a lot of the direct materials were or was not in the right shape to be introduced in the manufacturing process. Therefore, these inefficiencies would also be carried onto onto the next period, or onto the next fiscal year. This is the problem in using historical data. But an advantage of using the historical data is the historical data is already been collected. As accountants, we all know that according to our accounting information system, we record all these costs as we go along the production process, correct? Therefore, the cost of having this information would be low. Therefore, there is an advantage, and of course there is a disadvantage of using historical data. Another type.
Data from another companies have the same process.
Excellent. We could use the data or the prices or quantities from other competitors. But there is a problem here that gathering this information is not easy, if not impossible. Because as we all know, competitors will not provide this information to the competition, or will not provide this information to the market. But this would be a good indicator, or this would be a good, let us say, source of information, because we are benchmarking ourselves to the competition, if we had the ability to achieve or to gather this information. The last source of information in order to gather the budgeted prices and budgeted quantities is the use of a standard system. That means we could make up a team of engineers that would detail the activities within any manufacturing process. According to this manufacturing process, or according to this research by the engineers, or this engineering research, we could exactly know what is the amount of direct materials that should be used in order to produce a specific product. What is the amount of direct labor hours that should be used in order to produce a specific product. Therefore, according to this engineering research, or engineering, let us say, gathering of information, we could pinpoint the exact number of labor hours and the exact number of direct materials that should be used within our manufacturing process. Of course, the standard, or let us say this source of information is a good source of information because, first of all, we do not carry our inefficiencies from the last periods. Second of all, we pinpoint, let us say, the exact amounts. Therefore, we are challenging our employees to use the exact amounts that should be used and not the amounts that we expect to be used within this process or within the manufacturing process. We are going to continue, inshallah, the next time. Thank you for listening.